Chapter 10 is Peter Lynch's clear, no-nonsense sermon about what ultimately moves stock prices, earnings, and assets. If you notice a business, say Sensormatic, the inventor of the anti-shoplifting tag, and wonder whether its stock will keep climbing, Lynch's answer is straightforward. Ask how much that company will earn and how those earnings are likely to change over time. A share of stock is not a lottery ticket. It is partial ownership of a business whose long-term value depends on the cash it produces and the assets it owns. Lynch opens with a friendly analogy that makes the point memorable. If you evaluated yourself as a business, your possessions minus your debts would be your book value, and your ability to earn money in the future would be your earnings power. In the same way, a company's book value and its capacity to generate earnings determine what investors will pay for a share today and tomorrow. One of the chapter's central messages is that, over the long run, stock prices follow earnings. Lynch illustrates this using many examples. Companies with steadily rising earnings, like Masco, which he praises for decades of growth, have seen their prices climb in step with profits. Conversely, when earnings stumble, even great-name stocks can collapse. Avon and Polaroid are classic cautionary tales. Both were wildly popular at market peaks, but suffered spectacular declines when their earnings failed to match sky-high expectations. Because earnings matter so much, Lynch emphasizes that investors should know what drives a company's earnings and whether those drivers are sustainable. There are 5 basic ways a company increases earnings: reduce costs, raise prices, expand into new markets, sell more of the same product in existing markets, or trim or exit losing operations. When you find a company you like, your homework is to identify which of these levers management is using and to check periodically whether the plan is actually producing results. That naturally brings us to the price-earnings ratio, the familiar shorthand that summarizes how much investors are paying for $1 of current earnings. Lynch explains the price-earnings ratio, often said as PE, in practical terms. A price-earnings ratio of 10 implies that current earnings will earn back your initial purchase in 10 years if earnings remain unchanged. A price-earnings ratio of 40 means 40 years. That is why extremely high price-earnings ratios are risky. The company must grow earnings a great deal to justify the purchase price. Lynch provides vivid examples of absurdly high price-earnings ratios and their consequences. He recalls a brokerage report that implied an earnings multiple so extreme it would take centuries to recover the investment, and he catalogs famous cases: electronic data systems, Avon, Polaroid, where the stock market's optimism outran any plausible growth story. The lesson: avoid paying a price that requires heroic earnings growth to deliver a normal return. But price-earnings ratios are only useful when used sensibly. Different categories of stocks normally carry different typical multiples. Slow growers tend to have low multiples, stalwarts a moderate multiple, and fast growers command higher multiples because investors are betting on future growth. You should not compare the multiple of a utility to that of a fast-growing retailer and call one expensive and the other cheap without context. It helps to look at a company's historical price-earnings levels and to compare its multiple with industry peers. Lynch also cautions about market-wide exuberance. When the aggregate market multiple drifts far above historical norms, he cites the bull market of the 1980s as a time when the market price-earnings ratio roughly doubled over a few years. That is a sign many individual stocks are carrying inflated expectations. While he advises investors not to try to time the market, he recommends being mindful of valuations. Wildly elevated market multiples usually end poorly. Because forecasting exact future earnings is hard, Lynch gives practical, defensible advice. First, avoid buying companies with excessively high price-earnings ratios, unless you have strong and credible evidence that earnings growth will materialize. Second, when you find a company you like, identify the mechanisms management expects to use to grow earnings and monitor whether they are working. Third, compare the company's price line to its earnings line on a chart. Big and persistent divergences often resolve in favor of earnings. Fourth, use industry and historical context to judge whether a given multiple makes sense. Finally, Lynch reminds readers why we look for fast growers in the first place. They are the businesses capable of producing 10-fold or 20-fold returns, but that opportunity comes with greater risk and the need for close attention. Slow growers and stalwarts can be wonderful long-term holdings for many investors, but if you expect explosive returns, you must pay for potential growth. And that payment is reflected in the price-earnings ratio. In plain terms, earnings tell the story, Price tells you whether you are paying sensibly for the story. Know the story, understand how earnings will be created, and do not let speculative multiples or faddish optimism replace basic homework. If you follow that discipline, you will avoid many of the costly mistakes Lynch highlights and be better placed to capture the outsized returns that happen when earnings and expectations finally meet.